Gold went up, $160 an ounce in a couple weeks after October 7th. So yeah, there's been some movement. And that was on the heels of gold actually pulling back significantly. We got all the way down into the low 1800s on gold, and silver followed and outpaced like it always does. So both metals suffered, and both metals are benefiting, although gold is benefiting more right now since war broke out. You know, if you can catch silver at the lower levels before it outpaces gold, the profit potential is amazing. I still think gold is your answer for wealth insurance. But if you're looking for profit, I actually skew it towards silver there. I think within a 5-year period, I would think for sure you're going to see some incredible benefit out of owning some silver.
In a recent assessment, Checkan, president and CEO of Asset Strategies International, pointed out a crucial factor influencing the current gold market dynamics: the absence of active participation from retail investors. In his view, gold is currently taking the lead, with silver following suit. However, Checkan believes that silver has the potential to surpass gold in terms of percentage gains, particularly in the context of a bull market. The recent rebound in gold and silver prices was prompted by cautious sentiments expressed by several Federal Reserve officials regarding the next steps in monetary policy. Despite a dip in silver at the beginning of the trading session on Wednesday, it quickly reversed course, displaying signs of resilience. Checkan sees the current market conditions as an opportune moment to invest in silver, significantly before it potentially outpaces gold. The key outside markets have generally favored gold and silver. As of the latest update, December gold was up $9.30 at $1,967, and December silver had risen by $0.272 to $23.005. Central banks are still very strong, but the investors are not in this market, he said. I don't see us going above $2,000 and sustaining prices above $2,000 without investors in the marketplace. They're actually selling and not buying right now. Join us as we delve into insights shared by Checkan. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
In a bull market, I think, we may have talked about this before, I'm not sure, but the relationship between gold and silver in the precious metal space, gold is your leader, silver is your follower. But silver is a much smaller capitalized market. So I look at the gold market as being very massive and the silver market being much less so. Liken it to throwing a stone into a lake versus a puddle. Gold is the lake, silver is the puddle. It makes a much bigger relative impact, right? So when gold goes up, silver starts to follow, and then eventually outpaces gold to the upside. It's much more volatile. When they turn the corner and go down, gold leads down, sets the trend, silver follows and outpaces and dives deeper. So gold moves up, and it is. Silver is your laggard, but eventually it will catch wind in the sails and shoot well past gold. Last bull market, over 10 years, that happened to the tune of 650% appreciation in 10 years for gold and 1,000% for silver. So it outpaces significantly. That hasn't happened yet. And we were talking offline, a good friend of mine, Omar Ayalis, he wrote an article for our newsletter this month where he talked about the 11-year cycles in precious metals. And he basically, Omar is saying that the bottom was in 2022 for gold and silver, which means if you're looking to buy, now's probably a pretty darn good time, I would think, for both. Gold went up, $160 an ounce in a couple weeks after October 7th. So yeah, there's been some movement. And that was on the heels of gold actually pulling back significantly. We got all the way down into the low 1800s on gold, and silver followed and outpaced like it always does. So both metals suffered, and both metals are benefiting, although gold is benefiting more right now since war broke out. And we talked about the banking crisis in the first quarter. That's what triggered the buying. Second quarter, everybody said, ho hum, everything's okay. There's nothing to see here. And then in the third quarter, stayed level. I mean, there wasn't much of anything, continued to range trade. And then on October 7th, when Hamas attacked, Israel, everything changed. I think we're seeing safe haven flows into gold. I think we're seeing some crisis speculation into gold, and that's all kind of short-term stuff. I don't think it is enough, along with the continued by the way, central bank buying, which is about to surpass a 16-year record from last year, this year. So central banks still very strong, but the investors are not in this market. And I don't see us going above 2,000 and sustaining prices above 2,000 without investors in the marketplace. They're actually right now selling, not buying. Two things about gold in the gold market right now. So first off, like I said, we saw a $160 swing in 2 weeks in gold upward because of the crisis. I am not a big fan of chasing the gold price higher, okay? I'm not worried. I don't want to be a fear of missing out type person, say, oh my God, I got to buy a whole bunch now. I also look in the other direction. I don't want to stop buying because the price is moving up, because long term, that's where the price is going, okay? So my suggestion there is don't chase, don't abstain, just continue to work your plan, okay? Do whatever you have in plan to build your allocation over time and just do that, okay? Don't be affected by these short-term movements in the market. A longer-term steadying force, so this is my second point on gold right now, is the central banks. They continue to buy for all the reasons that we buy gold. You know, there's no default risk. It's a long-term store of purchasing power. It's a great hedge against inflation. It actually does well against deflation. You name it. All the reasons that we as individual investors buy gold, that's why central banks are buying gold. That's why they're repositioning their reserves out of dollars and into gold. And we should follow their lead. These are legitimate reasons for us to own gold, to be our own central banks.
The central bank left the Fed funds rate in a 5.25% to 5.50% range for a second consecutive meeting last week, and kept the door open to another hike, although apparently with less conviction than before. Checkan suggests that such a decision could offer relief for the middle class and banks, potentially influencing investment patterns, including those in precious metals. Contrary to market expectations of a potential peak in U.S. interest rates, Federal Reserve officials, including Chairman Powell, expressed uncertainty on Thursday regarding whether rates are sufficiently high to combat inflation effectively. This uncertainty has introduced a new layer of complexity into market expectations. Checkan adds an intriguing perspective to this scenario, suggesting that the real turning point for gold may come when the Federal Reserve begins to lower interest rates once again. Let's get back to the interview.
Right now, sentiment is low. There's no question. People are looking at alternatives, but I think the bigger issue here, let's face it, the middle class investor is what we're looking for to buoy this market and take it much higher. I think two things have to happen. One, they have to feel better about their personal financial situation. Now, Jerome Powell, chairman of the Fed, spoke yesterday, I believe it was, in the Q&A, and he said, part of the problem is we underestimated the resilience and the strength of the household financial situation. We underestimated the amount of savings that individual households had, and I think he's got it dead wrong. He's looking at price, consumption numbers going higher, and basically saying that, that's because the household balance sheet is strong. I don't think that's the case. I think consumption numbers are going higher because the middle class is buying the necessities they've always needed to buy, but after 2 years of inflation, they cost more. That's all that's happening. We're not buying any more. We're just spending more for the things we've always bought in the past. On top of that, I think the Fed has damaged two different things. First, I think they damaged bank balance sheets, possibly irrevocably. We will find out. But with interest rates going up so far so fast and basically putting all these unrealized but necessarily coming losses on the bank balance sheets, I think he's really harmed a lot of banks, not just the ones that have failed. There's more lined up to do so. And then the last thing is we're seeing investors actually selling gold here, not buying it, not their whole position. They're selling pieces of it to meet needs as they go along. And that's the wrong direction for sustained prices higher. We joked a little bit at the beginning, the Fed is breaking banks. They're breaking the backs of the middle class. They're doing a lot of breaking, but it's not dancing, okay? So Where does this change? I think when the Fed starts lowering interest rates. I think that's when we start to see some relief for the middle class. We potentially start to see some relief for the banks. And I do think it's coming. They got to be at the end of their rope. I just look at this and I say $33.5 trillion of debt at 5 to 5.5%. They can't afford it. They can't afford it right now, let alone 1 or 2 more rate hikes or whatever else. So I think Chairman Powell knows he's out of ammunition, and he's doing his very best to pause and talk tough, right? So the markets don't go running away from him, right? If they realize he's done, the game is over, right? Everything starts shooting up again in price, and he's lost to inflation. So I think he's trying to talk tough, but he really has no more ammunition. He may raise rates 1 or 2 more times. I don't know that he can, but he may still do it just to back up the narrative. But once he starts coming down, that's when I think it's really gold's time to shine. And I think that's going to happen next year, probably at the latter half of the year, but I think it's coming. If you ever doubt that gold or silver or what have you are doing their job in your portfolio, zoom out, take a look at the long-term picture, get away from the mainstream noise that are trying to sell you something else in your portfolio. And what you'll see is the price of gold and the price of silver, honestly, the price of anything with meaningful value or worth goes up over time as measured in mismanaged fiat currency. And I don't see us managing our fiat currency because I know that Powell can't do everything with interest rate manipulation. He needs the help of Congress. They have to stop overspending. They can't spend money we don't have, and there seems to be no appetite to do the right thing. So as long as that's the case, and it's been the case for decades, holding things of real value measured in worth less dollars is a good proposition.
After getting ahead of itself, gold has been consolidating below $2,000 since the beginning of November. However, I remain bullish for year-end as long as it stays above $1,900, said Hugo Pascal, a precious metals trader at Improved. From a technical perspective, silver is neutral to downward bias and would extend its losses once it achieves a daily close below the latest cycle, low seen on October 26th, a swing low of $22.44. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.